Welcome to Do You Ever Wonder? The show that brings you answers to many of the questions that you may have, but with no one to ask. Do You Ever Wonder is hosted by Mike Haltman, CEO of Hallmark Abstract Service, who, like you, has always been deeply curious about a wide variety of topics. Each week, Mike will be speaking with guests who are leaders in their field and who have inspirational stories to tell. So now, sit back and enjoy the show.
Hello, everybody, and welcome. My name is Mike Haltman, and I am the host of the Do You Ever Wonder podcast, created by Hallmark Abstract Service, really to bring guests on who we think can really provide something to our audience, some aspect of business or life that we feel could really be beneficial. And today we're very excited because we have with us a commercial real estate finance expert. And as I was watching the markets today, and the 10-year bond, Treasury bond, is pushing towards 4%. There's all kinds of angst in the marketplace. I don't think there could be no episode that's more timely than this one. So I just want to give a quick overview of the commercial real estate finance market. So I guess it was about 3 months ago that Signature Bank went out of business. Signature Bank was probably 12% of the market in terms of lending on multifamily and other kinds of commercial real estate. And maybe more importantly, or equally as important, is the vast amount of commercial real estate loans that are going to be coming up for refinance this year. In a $4.4 trillion market in 2023, $728 billion worth of real estate loans are going to come up for refinance. Next year, about 660 billion. And some might say, how are people going to get that? How are they going to get those loans refinanced? So, just as another quick overview of the market, interest rates are up, income or net operating income on buildings is down, cap rates, which is a return investors look for on a building, they've gone up, and banks are really pulling in the horns on lending to a great extent. So, you also have some serious out of favor sectors. I think everyone's familiar with the office market, and the delinquency rate on CMBS loans are rising. So it's kind of like a perfect storm in terms of supply and demand. There's going to be a ton of supply, a lot of demand, and finding loans is going to become much tougher. So all of that being said, welcome to today's guest, Stuart Gelb, CEO of the Liquidity Source. Welcome aboard, Stuart.
Hey, Michael, thanks for having me.
Absolutely. So, just as a brief beginning, a lot of people, if they have a loan, they got that loan by going to the bank on their corner. They live near, I was going to say Chemical Bank, but that might date me a little bit. But they go to the bank on the corner. They go in. They tell them what they're looking for. That bank may or may not do the loan, and they'll get the rate that the bank wants to give them. But for borrowers, is going to the corner bank necessarily the best way to proceed?
Great question. I think as a starting point, you might as well go to your comfort level place, and if Joe's your guy and he's been your guy for like 5 or 10 years, so you go there to find out like what's doing, what are they seeing in the market? What are the rates? And not only the rates, what's going on with things like debt service coverage ratios, because when those, not to get too much into the weeds, but when those rise, the amount of the loan goes down. And when the rate goes up, the amount of the loan available goes down.
So just as a quick overview, so the debt service coverage ratio is the number of times that the net operating income for the building will cover the debt service for that loan, correct?
Basically.
Okay.
So typically they used to be 120, 1.20 or 1.25. Now it's 1.30. So and then the other point is some of the banks that were giving 30-year amortizations may be at 20 or 25. Every one of those items changes the amount of the loan they're going to give you. So you might as well start out with a friend and just get a sense of, what they're doing. But I think it's equally important to realize that with markets being tough, you really don't know the condition of your bank. You don't really know, they might not even be transparent to you and let you know, what's going on with all the depositories. Have a lot of them left to chase and larger banks for safety? Are they in good shape? Are they making loans in general? Are certain property types, they may not even be making loans. Some of our largest banks that we know of, that we were doing some large construction in right now are not doing any construction. So it's worthwhile to first find out what your bank could do, and then go to an expert that's in the space that knows like 15 or 20 or 25 banks, but also understands your specific situation. What is the thing that, is the rub for you? Are you cash flow sensitive? Do you need 30-year amortizations? Rate is always important. Nobody's going to say no, but is the debt service coverage going up very high? And it's only, you can't go on the internet like you would shop for anything else, right? I mean, you go on the internet, you shop for things, you get answers right away. Banks are different. So you have to find somebody that can reach out to the bank and say, look, this is what I believe they can deliver. And from their expertise, they've done a lot of deals there. They should be able to deliver what they tell you. So I think it just makes sense.
Let me ask you a question. So I'm I'm a somewhat novice building owner. My loan is coming due. I go back to the bank that originally gave me the loan. Are they going to tell me the truth that they're not really interested in refinancing that type of loan anymore? Or are they going to put me through the mill, go through the motions, and then 2 months later tell me that underwriting said, we're not going to do the loan?
It's a great question. I can't tell you that what I'm going to tell you right now is 100% correct, but I can tell you, if the guy's a friend and without total transparency, if he starts to give you rates that are very high, there's a good chance that you're not going to get a loan, because they're doing it not to say no, but they know that at 7 3/4, you're probably not going to use that bank, as an example. But if you're friendly with the guy, there should be some kind of relationship enough to say, listen, you should shop elsewhere, or we're really having a hard time. Like, for example, offices, they're all having a hard time. Offices are very tough.
But do they not want to say no because they don't want to lose the banking relationship? So they'll drag me and give me a rate that may be totally out of the ballpark instead of just saying no? Do they want it to appear that they're working with me and that they want my relationship to remain the same?
I think it could be a little of both, and it really depends on the individual.
Okay.
You can't be 100% sure.
Right.
But it certainly would help, whether it was me or anybody else, that if you go to somebody that has a lot of access to a number of banks and has the expertise for a number of years, at least you can get another feeling for really what's out there and what's credible.
Right. So, to try and bring this down to a real life example. So let's say in 2018, I took out and we can adjust the numbers, $100 million loan, or a $10 million loan, or a $1 million loan, and it was a 70% LTV loan. So I borrowed 70 million, or I borrowed 7 million, or I borrowed 700,000, depending on the size of the loan.
Right.
We are now at refinance time. Usually these loans have 5-year increments.
It depends on the bank, but 5, 7, or 10 year.
Okay, so now as a borrower who needs to refinance this loan, what would you say my best first step would be?
Well, the first step, of course, is to go to your bank to find out what they say they're doing to begin with.
Now,
the next thing is understand that you're not going to be able to change this, but property type and location is extremely important when you go to the bank, right? Because if you're doing multifamily, which right now there's a shortage of units. I was told, in fact, like in Long Island, there's 150,000 units short on property units in multifamily. those types of property types will be the easiest of all to get refinanced. And you'll probably get the best LTV. It won't be 70%, maybe 65%. And so far, most of the cap rates, they were at 5%, are still in that 5% range because rents have been going up. So it depends on property type. It also depends, where your location is. Are you in New York? Are you in Long Island? Or are you in the difference depending on the city you are? Everything is a little bit different depending on location. Like, for example, in Florida, if you have stuff in Florida, the stuff has been phenomenal. So it's going to be easier.
Now,
So
is there a benefit in going back to the same bank? Is there a benefit in my cost to refinance, or it's the same whether I stay there or I go somewhere else?
I think going somewhere else, depending on what you're being told, something that you need to do, because what would be the difference if the gentleman that you're working with says, look, we love you, we want you to stay, you have multifamily, we're going to give you a 20-year amortization at a loan of rate of 6.75%. We're just juggling numbers here right now, and we're not going to charge you a 1% fee. And what if we can get that same person a 6% mortgage, a rate, and 30-year amortization, so the cash flow is going to be substantially different. The individual has to make up his mind what their favorite solution is and what do they really need to get best out of this property to be, to be happy.
Right. So now, on the corner, my bank is probably going to be a money center bank, or actually, that's not true. But is there a benefit to a regional bank versus a money center bank in terms of willingness to lend, the way that they underwrite a loan, are they looking to say no, a regional versus a money center, or are they looking to lend and just have to go through the steps?
So give me a better idea when you say money center bank.
Like a Citibank or a Wells Fargo or a JP Morgan, the two big.
I think though, what you call the money center banks, number one, depending on, again, property type. Let's say you want a construction. All those multi center banks have no appetite for construction. I'm not saying they never do that. Wells Fargo may do $100 million loan, but I think even Wells Fargo, they've all stepped out of that for the moment. So again, property type is really key.
Right.
The regional banks, yes, we've known that a lot of the regional banks have had some problems, but some of them are stronger than others. And one of the regional banks that I have, without mentioning names, very large, not doing construction right now because they have also too much in that space right now. I think that was the reason when Signature went out, they had about 50 billion that they went to, I think, when they were taken out to Flagstar, right? Flagstar didn't take 50 billion of the property because there was too much real estate. So people are watching that. So it depends on the regional bank, what they have, in assets at the time and what they want to continue to do.
So how did they offload the piece of the 50 billion?
I think they gave it to a major place to sell it off. Because I heard they're going to give like 50 cents on the dollar, and they're going to get rid of it.
And my understanding was that a lot of their loans were in fairly good shape.
Sure, but I think it's probably what I'm going to say now. What I think is impossible. If you went to some large institution to sell 50 billion worth of properties, how long would it take to do a full analysis of, let me check all the leases to see who's not paying on time, things that they would just normally do anyway, right? So they probably take a bigger discount than they normally would be covered in the end, right? Because that would be impossible to do the total global cash flow of the individual, right? Like, what does he have on the books and who's paying what, but
100%. In 2008 or 9 or 10, I knew the guy who was in charge of the subsidiary of Lehman Brothers that was created to offload all their debt, their loans, and it was, you're 100% right. There's no way someone can do due diligence on that kind of a portfolio.
Very difficult.
Absolutely. So tell me a little bit. I think when you go to a bank and you want to get a loan, they will want you to put money at that bank.
Sure. So that's a good question, because a lot of the regional banks that we go to now are asking for 10% deposits. And not only 10% deposits, including loans that you may already have there. So if you had, for example, if you're asking for a $5 million loan and you have $10 million of loans there already with no deposits, they're probably going to ask you for 10% on the whole 15 million, which would be $1.5 million, which is quite a lot of money.
And are they going to want me to keep it there? The story I always heard was they want compensating balances. You make the deposit, and then the day after you close on your loan, you pull it out and put it back where it came from.
So that's a great question. So I'll give you an example. So I had a meeting with the major bank that we we're just actually discussing. And I said, so what happens, compensating balances, they can just take it away, right? He says, let me tell you a story. I have a client, great client, and I told him I needed $2.5 million of balances in order to get the loan done. And he gave me a $2.5 million balance. And then we closed. And a couple of weeks later, he removed the $2.5 million. I called him. So he says, and I said, so what'd you say? He said, I just want you to know, I understand what you did. And I understand that, you gave me the money and took it out. You had every right to do that as far as, the legality. Just don't ever call me again after this loan.
Yeah.
So there's something about the balances that, I think that the balances that the people are asking for, and by the way, the people are not, the ones that are asking that are not giving the balances, they're not even getting a shot at doing a loan though, even though they were a successful and a great client prior. So that's like, you have to do that.
Right.
So by giving all these loans, it's giving the bank some additional collateral against people that are pulling money out of the banks, right? It's giving them additional security, and that's what they're after.
100%. So, you talk about don't come to me for another loan if you take out your compensating balances. I remember, so years back, I owned a commercial mortgage company. And, I always used to say that two people could bring the same scenario, the same loan, the same everything to an underwriter. And one guy will get a yes and one guy will get a no, because everything is relationship driven. And, pulling balances out of a bank is the same as trying to shovel snow on an underwriter.
But the thing is also, remember something. Imagine all the underwriters are under a different viewpoint of what the bank wants or needs depending on their condition. If the bank has a lot of construction loans, for example, and you're coming with a construction loan, they may just say no through underwriting because they have too much of that on their book, right? So it's not all the same.
Right.
Like I said, most of the time, multifamily is very strong. Most of the banks will go for it. Staffing, storage is also strong. And industrial is very strong. And there are a couple banks that are doing office. But the problem with office is that a guy can have an office with 10 tenants and everybody's paying on time and everything's going great. The problem is the bank says, if I redo this loan for even 5 years, what happens to the guy that's loan is coming due in a year, or the guy that's coming due in 2 years, or on and on. And they decide at that point to leave the place or ask for less, to pay less rent or all those things. It's a huge potential issue. So what would a bank do? The bank may do the deal, and give a low LTV and maybe 40 to 50%. And still, even with that, they're all going to be signing personally. And then what is their global, what does the global look like? You know, with other buildings, how strong are they? And what does liquidity look like? Are they strong enough that there's a problem? Because they may not be all offices, you know, they may have 2 office buildings and 3 multifamily, you know, different things. And they have to size up from underwriting. Is this going to be a safe bet?
I mean, you know, if you told me 7 years ago that, you know, an A or a high B level building would have to, an underwriter would have to consider the fact that they weren't going to be able to rent space, you know, I wouldn't have believed it. But it has to be a very difficult decision. I mean, I think A buildings are doing fine, but
Yes.
B's and C's, I don't know what's going to become of them.
They were talking today, I read an article that they expect 1 billion square feet of vacant space in office buildings in the country. Some people predict 2030 or 2040 till they get back. And some of the buildings they can convert to residential, but they have other challenges. Like in New York, they may have a building, depending on light, air, and different qualities of the building, that they can actually build the residential, but they may not get the zoning approved.
Well, I think
You know, it's not just about, you know, it's not just about that. You know, what are they going to allow? What's the city and the state going to allow for that property? So some of the malls are also turning into residential. They're trying to be creative.
I was going to bring that up later on about government intervention. And, you know, you take a city like New York City, the powers that be have to be a little more flexible, a little more creative, but I'm not sure that's going to happen. So I'm not sure what the state of affairs is going to be in 10 years. If, you know, for all of the rules that are coming into place in terms of bringing your building up to certain standards and all kinds of other rules, the money that's required to maintain a building, it becomes difficult to be an owner.
Well, imagine this. Imagine if you have a B building that was worth 100 million, and today it's worth, let's say, 40%, you know, devalued. Now it's worth 60 million maybe, or 55 million. And now you find out you got the green light for residential. What's the CapEx cost? And what's the bank going to be willing to lend? Now, if you have a $60 million building, you may need $40 million. You know, they said like $500 a foot to redo. I mean, who's going to have that money?
That's a good question. And are there lenders? So I wanted to ask you this question too. Let's say I go to refinance that $100 million loan. I had a 70 LTV. I got a $70 million loan. Now the building's only worth 80 million. And
I would say no. I would say that you're being nice, and I think that's probably worth 60 million because
okay. So the bank is now going to lend me 40 million on the $70 million loan I took out 5 years ago.
but they're not going to even lend you 40 because that's 67, 68%. They may lend you 50%. So on the 60 million, they may be willing to give you 30. The point is, if you took a $70 million loan 5 years ago, you still may owe 65 million. I mean, you haven't paid much off. So do you have $35 million in cash?
Well, that's the question. So are there lenders out there, and I don't know how it would be structured, but are there deficit lenders? Is there any cottage industry where someone will lend the deficit that you have on your loan?
I think it's a good question, but I would tell you, I think you have to look at it like a hard money guy would look at it. There's a couple things. It's like if you owned a building in New York that was worth $10 million, but you didn't have any W-2 income and you wanted to borrow $100,000, you're not borrowing $100,000. So, you know, that's an issue. It's going to be very difficult. Getting back to the hard money guy. So the hard money guy goes, okay, look, love Michael. He's a great guy. I think the building is problematic. All I want to know that if everything goes south, how am I getting my money? There's no free ride here, right? You've got to have it. There's got to be a way that there's an out for the bank. Typically, even when in good times, the bank likes 2 outs. The property's value is really strong, or strong for, for the property, the location. And there's enough liquidity, for example, that if there's a problem, they're going to be okay. But look at some of the things that we've experienced. Think about the pandemic. Imagine people, or some people, buying a 200 or building a $200 million hotel. And when they laid in bed at night, like the worst case scenario, like what would they be worried about? Oh, so maybe it won't fill up, 90%, 80%, I'll be able to carry it and all that. And then the pandemic comes, and now they have either immigrants or drug users living in those buildings. I mean, it's things happen that are not even believable.
No.
So now with all the other currents that are going on, I think that the banks are much more cautious than ever. At the same time, the banks don't want the keys.
Correct.
Right. So it may be a condition where if the guy's strong, so maybe they'll do lend and extend at 4% or 3.5% for the next 5 years. So they don't have the default. So I think it's really like everything else in life, an individual situation for the, for the client, and the individual situation for, what the bank has on the books, what their defaults are, what the rates are, what the loan sizes are, what's the condition of the bank, how strong are they?
Right. So we really haven't seen, I don't think, I mean, you've seen a few big buildings where they just handed the keys back. I think RXR or Reckler handed some keys
Major guys.
Major in the many hundreds of millions of dollars.
Right.
So beyond those, we really haven't seen I don't think, the extent of what could be. Would you agree or disagree with that?
I do agree when it comes, I don't want to conflate real estate, the CRE, by not separating office and the rest of the market, right?
Correct.
So I would say, my understanding is office makes up about 20% of CRE in general. And most of those loans, according to Blackstone, the leverage is average about 55% leverage. And there's not that big of as big a percentage on the balance sheets of a lot of banks that one would think. So from that part, it's a little positive. But yeah, I think you got to figure out where the bank is in all this, and office space is very, very difficult. But that doesn't mean that multifamily's off. It's, they call it what, bifurcated society. We have like South Beach is like tripled since the pandemic, right? You bought something there for $5 million, it's worth $15 million. They're building offices there. There's a lot of things going on. And then you got a lot of these communities all over the country that a lot's not going on.
Right.
So it really depends, again, property type and location.
So different, and when I was in the commercial real estate business, the difference between residential and commercial is astounding, that most people don't really understand. 2 houses in the same neighborhood are going to be measured on an appraisal basis on recent sales in the neighborhood, where 2 commercial buildings could be side by side, identical, and have different values. And then you bring property type into it, and everything. I just think commercial buildings, everything tends to be very unique to a specific building.
Yeah, I think that's true, because to make it simple, there could be 2 buildings, a property type that's mixed use and maybe some residential. Okay. And one of the guys that has a mixed use has has FedEx and has some real CVS drug there. And the other guy has a mama papa pizza store and a cleaner, and it's still mixed use, but and the building could even physically look the same. I mean, of course, like a FedEx, you'll see it's going to look different a little bit, but the guts of that building, the length of term of the leases, you could have a great tenant with only 6 months left.
Right.
So all these different things. So there's much more of analysis when it comes to that than the home.
100%.
So yeah.
We're running out of time, but let me ask you this. In the realm of commercial real estate, if somebody goes to a broker versus the bank direct, at there are, for the most part, because you're going to be shopping so many different banks, even though you have a fee, will they tip? And there is no typical, but will they have the great potential to save money, including your fee, because they're going to get better terms, a better rate? The mechanics of the loan will likely be much better than going to one bank and taking what they give you.
So it's a great question, but I would say can't give you the exact percentage, but my experience, and I've been doing it for 15 years, in most cases, by shopping it and getting them the better rate, the longer amortization, the wiping out the fees that the banks are charging, because some people don't even ask the bank, is it 1% fee? They just let it go, you know? Right. There's an enormous amount of points, changing the debt service coverage ratio, getting a better rate, all the different things. My experience is on a loan of like $3 or $4 million, you probably save hundreds of thousands of dollars for the individual. Now, the other side of that would be the people that went to their bank, like you say, a money setter, and right now the bank says, I'm not doing that loan. And the guy doesn't know where to go. There may be banks that instead of charging 7% may charge 8.5%, but at least the guy is going to get a loan and not be out of business, right? So you may just need that loan. So on that point, did I save him money? No, but I saved the building, saved the guy, saved his business to a certain extent. And then there's things like you can do that you may, like a guy has a 3% mortgage from 5 years ago, and now he's going to go to refinance because the term's coming up, and maybe we work something out by using the collateral of the other buildings that he has to get or maybe we get him a second mortgage, or maybe we get him a line of credit. There's all kinds of things that you can do. Right. So if he still had a great rate, we figure out things that he can do so he can keep that rate and go elsewhere to get the money so he can continue to build the business. There's all, the ideas is they have somebody that does this every day that can think of different things. Like you're great in title. You're going to say you're going to give people solutions. We're giving solutions to their issues beyond what not that their mental scope, but that we, from our experience, know how to deliver something that'll be exceptional for that person.
You're looking for answers versus just going with the status quo and
solutions. Always solutions.
Well, that's fantastic, Stuart. You know what? You are a true professional. I appreciate you coming on.
I really appreciate the opportunity.
Oh, anytime. And if anyone is looking to contact Stuart, it's the Liquidity Source. And you want to give your email address?
Sure. It's Stuart@theliquiditysource.com.
Easy.
And if you just want to chat, there's no charge. And even when we do a deal, it's success fee only. So there's really no risk.
Beautiful. Stuart, thank you.
And thank you. Pleasure.
Thank you for listening to Do You Ever Wonder? And we hope that you enjoyed the show. Next week, we will have another terrific guest telling their story. And if there are any specific topics you'd like to hear more about, please don't hesitate to let us know. Our curiosity, like yours, knows no bounds. Please subscribe and like and share this episode on your social media. See you next week.